Here we go. Box spreads. It's not free money. Believe it or not.
Yep, it definitely is not free money. We're going to talk about box spreads and some of the things that you might be missing with these. We get cycles of emails, like every couple months we get an influx of people trading box spreads. I don't know if it's somebody on YouTube that has some video that's like getting into the algorithms that everybody's watching, but we've been getting a lot of questions about them right now, and so we're gonna dispel some of the myths here. So a box spread consists of selling a put spread and selling a call spread at the same strikes. So the position itself is long stock at one of the strikes. So your long call and your short put, synthetically, that's a long stock position. And then short stock at another strike. So your short call and your long put, those are at the same strike. That's your short position. So you're long and short at different strikes, and you're doing the transaction for a net credit. If you were to do that transaction just being long stock and short stock, that would trade at zero. The box appears to give you some sort of risk-free value while being both long and short the underlying. So the idea here is that you are capturing some sort of arb value of the spread via, either wide bid-ask spreads. When you look at these positions, you might see, wide bid-ask spreads where you're marking at a much higher value than what that spread is worth. Or if you're trying to play into some sort of inefficiency or illiquidity in the market, which, both of these are kind of, not really on the table anymore, just given technology and access to the markets now. The other potential reason is to dividend arb via potentially avoiding assignment on the short call. So the thinking here is that you sell this in the money call or this in the money spread for more than the width of the box, so it has some perceived free value to it. You avoid the dividend and you keep that value because you close it the next day for parity, and you kind of arb that value. Both of these scenarios, technology has taken that out of the equation, right? So this box trade existed when technology wasn't where it was now, in that, you might trade 100 lot of a box trade and maybe 5 of them or 10 of them don't get exercised, or you don't get assigned on the short calls, and you keep that value. So you have to have a large account or some sort of potential for that to happen. With technology now, almost all of those exercise assignments aren't voluntary. They're done automatically via your whatever brokerage you use. And of course, tastyworks is going to do whatever is most advantageous for you. If you have an option that is long, that's in the money, that should be exercised, it will be. That's all done automatically. So this scenario of arbing the dividend is just not feasible, especially for retail traders, just because you're only trading 1 or 2 or 10 contracts. You're not doing 1,000 lot of these and getting 5 of them to squeak through the cracks. You're doing 1 or 2 of them. They're almost always going to be assigned. So really the only reason to ever do a box spread trade is if you're trying to close out of a position due to PDT, and that you should look at that as kind of a close now. You're locking in your position, and then tomorrow you take the whole thing off. It's not something you leave on. It's a way for you to if you sold a put spread yesterday in SPX, and SPX rallies what was it, up 190 points yesterday? If it rallies and your account can't handle another day trade, you could just buy the opposite spread or sell the opposite spread and realize that value, and then the next day you close that position out just to avoid all the exercise and assignment there. And of course, the other question we get is like, okay, can I leg into a box spread? And of course, the answer is yes. If you are able to time the market and you're directionally correct, of course you could leg into this position being risk-free. But that's the question you have to ask yourself is like, okay, if I'm wrong on direction, now what?
Mm-hmm. And again, that's the emphasis, is that legging into a box spread is just closing the trade. Like that's what it is. If you, like Nick said, if you have a short put spread and you want to box it off, you're basically locking in the value that you're seeing there on that day.
Yes. All right, so a couple things you need to know about the box spread. So if the box is trading above parity, and we have an example on the next slide here. If the box is trading above parity, one or more of the below probably applies to this position. So the stock has an upcoming dividend. This is the most common occurrence where you look at a in the money short call spread and an out of the money short put spread, and you look at those two together and it's trading for more than the width of the spread. It's probably because there's extrinsic value that's coming into play via a dividend in the future. And that dividend will put you at risk of being assigned on that short call because the counterparty is trying to capture that dividend value. So dividend risk, probably the most common occurrence for people mistaking the box spread for free money. The other occurrence, which happened with most recently with all the GME and AMC craze, is if somebody is a hard to borrow stock, it would put you at risk via that short call because it's hard to locate those shares to be short that stock. So if you have a hard to borrow stock, you're at risk of being assigned on that short option. And this is especially the case with, stuff that's expiring in the near term, because if you get assigned on a Friday, you have 3 days worth of carry costs, Friday, Saturday, and then Sunday before you get to close the position on Monday. So if you have something that's got, 100 or 200 or 300% borrow rate on that position, and you sell an in the money call spread for, that's $3 wide, and you sell it at $3.20, that $20 in value that you're taking is, far less than what you're paying on, in interest on the potential short shares that you get assigned the next day after putting that position on. So keep in mind that borrow rates can come into play here. You might also look at this and see like wide bid-ask spreads. This is especially problematic if you're trying to leg into the position. So if you see this, sort of opportunity, or you're trying to leg into a risk-free box position and those bid-ask spreads are 10, 20, 30, 40, 50 cents wide, you might get filled, on the bid for your short put and, on both those positions. Like you might get filled at the worst price on all of the options that you're looking at. So keep that in mind. And this also comes into play for people that are looking at this trade on a demo or paper money type account. A lot of those platforms that have those type of accounts, they get filled at the mid price, right? So they just auto fill you at whatever the marked prices. So if you're looking at SPX, a lot of people, if you remember back in the day, Mikey, we would get people, making millions on their paper money accounts just by slinging, $10 wide butterflies with 1 day to go till expiration for, 5 or 10 cent credit. And that doesn't apply to real markets. So just keep in mind that if you're trading in a paper trading account or a demo account, just keep in mind your fills are probably a little skewed.
Maybe that's where this comes from. The paper.
Yeah. It could be. All in all, just keep in mind that the reward of the box, whatever this 20 or 30 or 10 cent credit, free money that you're seeing, you're going to have to take out costs and whatever other risks that come into play from this. So, your commissions, fees, cost to carry, what else do I have on there? Potential assignment, margin calls, pin risk, expiration risk, those all come into play. And you have to keep that in mind that it's probably not worth the 5 or 10 cents that you're making on that position to hold all this risk. All right, so the example that I'm pulling is in XOM. So XOM has a dividend in the middle of the week next week. If you looked at this box spread, so you could see I'm selling the 111, 107 short put spread. So it's a $4 wide short put spread. And then I'm selling the in the money call spread, the 107, 111 call spread. My long stock is at, or my short stock is at 107. I'm long at 111, and I'm doing this whole package at a $4.30 credit. So if you took all of those values together, you're short at 107, you're long at 111, that's minus $4 in value. If you're getting paid $4.30 in credit, net, you're keeping 30 cents of risk-free money if you looked at this position, right? So this is a box. This is an example of a box. The dividend that's coming up next week in XOM, 91 cents. So you could see that short call has about 85 cents of extrinsic value, maybe a little bit less now that XOM has rallied. We took this a couple days ago, but either way, you're definitely at risk of assignment on that short call because it has very little extrinsic value. If you were to get assigned on that short call, you'd pay the 91 cents, and net of all the transactions, of course, I have to put a net in here, net minus the 30-cent credit in risk-free money, and you're out 61 cents just on the assignment. That's paying the dividend minus the credit you get. And this is assuming you get filled at mid-price. You'll probably get filled on this spread the way it's marked. You can see it marked at 401 to 450. You probably get filled more at 410, 415, something like that. So it's probably even less than this, but we'll just use this as the example. So you're out 61 cents plus whatever costs you incurred going into this position. So a couple bucks in commissions, a couple bucks in fees, and then you come in the next day and now you've got a short stock position. So if you're in a margin account or a cash account or an IRA, some account that isn't allowed to be short shares, you're going to be in a margin call. You have to close that position. If you don't have the capital to hold that position, you're using 10 grand in a cash or an IRA account, 5 grand in a margin account. And then if you forget about it, you've got pin risk and expiration risk. So what happens if you hold that position and you say to yourself, okay, well, I'm going to just hold it because it's risk free and I'm going to let it go and just let all the options get exercised or assigned. If you get a move to 111, or if you have expiration risk and the stock, dips below or just above 111, you have pin risk at that closer at the money strike. So, you could come in Monday if those options are right at the money and not be exercised or assigned on that. So even if you do avoid getting assigned on this position, you got to think about the costs that come into play, all the risks, all the excessive risks, especially for a smaller sized account that come into play. All said and done, you're probably a negligible value add to your portfolio. Yeah.
And you just have to remember that if you see something that looks like an arbitrage opportunity, it can't be, because if it was, why would we be doing anything else? Nobody would do anything else. And if everybody's doing it, it would go away. So it's not something, anytime you see something that looks like an arbitrage opportunity, just realize that these markets are so efficient that it just cannot be. That's the best way to look at it.
You're not calling your broker anymore and getting a price quote over the phone.